If you look at the structured products, in structured products were effectively the cause of the global financial crisis. And, without going into the structured products with Bitcoin, it's really important to understand what the structured products were that led to the global financial crisis and how the structured products moving forward will isolate and remove that risk again from the system. And ironically, Bitcoin is the catalyst to avoid that. But if we just do a really quick brief history lesson on the GFC was effectively caused because Wall Street had an insatiable appetite for residential mortgage-backed securities. And they went to Main Street to say, hey, we need more, mortgage-backed securities, go and sell more loans. And Main Street banks went out to their clients and basically found people with lower and lower credit quality to the point where they ended up giving ninja loans, no income, no job applicant loan to people who literally were just breathing, could qualify for $1 million loan. And this was then bought from Main Street to Wall Street. They sold that up, they packaged it up, and by combining, millions of these mortgages for people who are of, questionable credit, they could package that up and call effectively a triple B or a double B, which was in raw terms dog shit. They could package that up and sell it as a triple A rated asset and, get a much better premium for it. And now what happened was when, the poor credit quality applicants who weren't able to meet the repayments on their loan defaulted, the value of the collateral fell, the value of the underlying fell, and this basically caused a domino effect all through the financial system, including all through Wall Street into the pension and insurance funds who had basically bought all these products and realized they weren't worth the paper they were written on. And so if I look at that and think, that was the most heavily marketed product up until this date that was effectively financializing and tokenizing US mortgages, effectively the US residential mortgage market, which is one of the biggest markets on earth. Now, why is that important to understand? Because moving forward, we're going to be able to create structured products in a that where you slice and dice it and sell it on to pension funds, insurance companies, and deliver this to the world by effectively packaging up two products, a US Treasury and stapling that to a percentage of Bitcoin or a Bitcoin ETF so that you merge the two and you create now a structured product in the form of a capital guaranteed principal protected note. And what that looks like is JP Morgan can now basically package that up as a capital guaranteed product where they create a $10 billion note. They go out to, their clients and they say, hey, we've got a capital protected, principal protected note. You're not going to lose anything because what we're going to do is we've stapled 80% of this product with a 5-year US Treasury paying 5%. So that assuming that the US government is effectively a risk-free borrower or risk-free lender, you've got no credit concerns over the US government being able to meet that interest payment and pay your principal back at the end of the 5-year term. So they'll take 80% of that $10 billion note and they'll jam it into the 5-year US Treasuries. The 5% per annum will grow from 80 to 100% of the capital value over the next 5 years. But that 20% difference that they've got that's not invested in the US government Treasury, they can use that to go and buy the Bitcoin ETF and staple that together so that they've got effectively an outperformance return on this principal protected note. So all of a sudden, you've got buyers of bonds globally who can now get exposure to Bitcoin risk-free because they've been able to meet their returns and protect their capital in nominal terms, not real terms, but they've got the exposure of 20% of what they put into it having exposure to Bitcoin. And so some backtesting on this that I did was with over the last 5 years, if you assume the current rate and the current returns, you'd be able to get an 18% risk-free return on this principal protected note moving forward.